Hey guys, today I have a video for you which follows my previous video that was how to buy stocks. I'll teach you when to sell a stock from your portfolio. Enjoy the video. Selling a stock is mostly about speculation and observation. First, if you don't see a company growing or giving value to its client in the future, you might want to sell. For example, if the company achieves maximum part of their market, there will be no more revenue growth and even a decline in revenue and so on the price of your shares. They might also be better companies, new ones, for example, that are taking clients or that are producing a better product than the one of the company you have right now. The next one is the company is not as popular as it used to be. So, for example, if clients don't go shopping at that store nowadays. The third one is if you don't like the company anymore because of bad financial strategies. So, there's new acquisition that you don't like. They cut the dividend from their shareholders to save money if their expenses and debt is growing faster than their revenues. These three are the main reason to sell stocks, and you have to keep in mind that if you keep a stock or you buy a stock to make a few quick gains and think about selling it in a few weeks, your philosophy might be flaws about trading stocks because of greed, which blinds you from the real objective of buying shares of a company. So I suggest selling every share that you bought because of greed. In the book The Intelligent Investor, Benjamin Graham referred as the stock market as Mr. Market. So this man might be referred to as manic depressive. So he is very pessimistic and wildly optimistic. Think about it like a door salesman. He's gonna come to your house every morning and he's gonna tell you about market fluctuations. So a morning he might be overjoyed about the markets going up and offer you shares that are gaining in value, or the next day he can come to your house and be very pessimistic about the stock market, telling you everything is down, so you need to sell right now before you lose even more. The key when trading stocks with Mr. Market is to not get scared and let your emotions guide you, because in the end money comes with time and you need to buy good shares and keep them for a few years or sell them when your price target is offered. The market fluctuation is the reason why you need to diversify your portfolio in multiple companies at least, because no one can predict the future. You can buy during the week and the price might go down 10 to 15% the same week, or you can buy a company and it goes up by 10 to 15% in the same week. You never know. So now, when you see the price jump up and down, before you think about selling, you need to look at the news about the company and see why the price changed. And after you analyze if you want to keep your shares or sell them, you have to reevaluate the company from the new changes. Here's a good example for selling a company. There was Warren Buffett who sold all his airlines during the COVID pandemic. Why? Because he believed that airline travels would not return to pre-pandemic levels because of the virus that would last a few years. So that means less demand, a decline in revenue for at least a few years, and you probably won't gain back as much as if you invest in a better company that was less affected by the COVID pandemic. So Warren Buffett sold his airlines and bought, for example, shares of banks, which would not see the revenue go down. Peter Lynch also talked about a few types of companies and why you should buy or sell them. So, for example, slow growing companies, you don't want to sell them if there's an increase in income from the last 10 years, if there's a consistent increase in dividend, and if there's no debt or insiders are buying the shares of the companies. If the price of the company resolves around inventories, so for example, gold mines, their price goes up and down depending on the price of gold. There's also refining companies or automobile industry. You want to keep them if you think the demand and the price of the inventory is going up, and you want to sell them before the price goes back down. For growth companies, you need to buy them when they are of a smaller size and they're still growing their earnings and their client base. You never sell a growing company when the revenue and the demand is going up. For example, Nike, Facebook, which are companies that are right now pretty big but still growing. You never want to sell them because it's your best chance to make money, because their price will increase the most out of all the companies you'll buy, and they will be good for about 10 to 20 years. Now there's also turnaround companies, which were big companies that are now declining at a fast rate. They now have a plan to rebuild the company or new CEO. For example, BlackBerry, they're now making new products and they have a new CEO, and you want to sell the company if their plan doesn't look good, so their product is not efficient or there's no demand from the clients. I hope you liked this video. Please leave a like if you did, and please consider subscribing. Bye.